We're just going to run you through sort of a bit of a finance tutorial. So how many people here are looking to do the finance role for the actual competitions coming up? So most of you, or yeah, so a reasonable number. So it's good that there's a few that are probably not doing the role as well, because one of the key things is that finance, yes, there's a role for it, but you need support from the rest of your team. So it's good to see there's a few finance people and a few support people. So let's get into it. So overview of the finance role. So the first thing you really need to do, or one of the first things, is to look at the current valuation of the company and kind of look at what they're doing at the moment. So this starts on reading time, when you need to actually go and look through the appendices, check how they're financially, how healthy are they running out of money. You can do that in reading time, and that's kind of one of your first little roles, and you can convey that to the rest of your team. And then, of course, later on you actually start building the models and building a current valuation of the company. Then the next key part that you'll be doing is actually valuing your strategy arm. So strategy people, you'll be all coming up with a strategy in your team, and your strategy person will be talking through that strategy, your implement person will be talking about how you implement it. You're kind of the person in between that says, you want to do this because it gives you X amount of dollars, and you also explain how much the implementation is going to cost on the other hand as well. So you kind of are the link between strategy and implement, and really tell them how much impact financially it's going to make. And of course, there's other key metrics as well, so it's not just about dollars all the time. It could be number of shops you're opening. I use number of app downloads in the weekend for one of the cases I did. There's various different things that you can do. And of course, finance role, you're probably the most time-pressured role. No matter how long you're doing in a case, you'll be time-pressured because of the fact that you have to crunch a whole lot of numbers. So, overview of what we're going to cover today. There's a bit of accounting basics. I assume most of you have probably done Accounting 101 and various other papers, and maybe some of the finance papers. You probably know more than me, so we'll quickly go through that. We'll look at slides and presentations, so what you actually need to output on the day. A bit of valuation and a few general tips, and there'll be time for questions at the end. So, accounting basics. So as I said before, in reading time you really need to have a look over the balance sheet and income statement that will be provided in the appendices of the case. Sometimes these may be missing, or you may not get as much information as you may like, in which cases you may have to make some assumptions or kind of just use your general knowledge about some of the numbers. But I think most of the cases they use for open case and first year case will have a balance sheet and income statement. So of course, balance sheet, it's all about assets, liabilities, and of course that will equal your equity. So sort of simple accounting stuff here. I think most people will know this. And of course, income statement, it's all about income, where they're getting the money from, what they're spending it on, and also a profit and loss. And actually look for these sort of parts when you're looking and reading the case, and when you start building your finances, look and check if there's any key trends. So there may be some trends about income, it may be going down, it may be expenses, and also look at them in contrast to each other. So one of a good check is sometimes, is your costs increasing faster than your income? Because that means you're going to run it at one point, your costs are going to become larger than your income, for example, and various other things. So they're kind of quick little checks you can do early on. So here's an example of an income statement. I'm sure most of you have seen one before. So it's all about the income, you've got a bit of expenses, and going through down to your profit and loss at the bottom line. So if you want more explanation, come see us at the end, but I'm there, probably skip through this because I think most people know about it. So of course, as I said, so the next bit is when you actually start valuing your strategy, you'll need to estimate your revenues going forward. So we typically explain two methods for doing this. So there's a top-down and a bottom-up approach. So we'll go through both of these. So in the case, you don't have to use both if you don't want to. You can use one or the other, or if you've got time, you can actually do both and see, kind of average it out in between. But I think in a 3-hour case, there'll be one that's probably much easier and suits the case a bit better. So let's get started with the top-down, I believe. So for top-down, it's where you start with the size of the market. You kind of look at what sort of share that you're aiming to get, or what you have at the moment, and then you work that down to your revenue figures. So in this case, they've gone for a market size of 100 for this product, and they've said that it's growing at 10% each year. Now, if you aren't given the market size in the case, think about other ways you can kind of estimate this market size. So it may be based on a sort of population figure, and a population will be spending, I don't know, $100 on groceries each week, and you can kind of figure it out that way and get a rough market size based on those estimations. And then when you're doing the case, you don't actually have to explain all your assumptions of that, but you may just say, like, we assumed a market size of this, and if they ask you, you can explain the reasoning behind and how you got that number. And of course, you'll then look at market share. So you may have been given that in the case it was 5%, and you maybe like, well, we want to achieve 15% by 2018. So that's how you kind of get those figures, and then you can translate that into a revenue figure in which you can present. So for bottom up, it's where you start kind of at opposite end. So you look at what the company is actually providing and work it up that way. So in this case, this is like a retail case, and you can look at the number of stores they're operating. So in this instance, they're starting with 10 stores, and you're looking to grow it to 30 stores by 2018. And then you can say, let's think about how many customers are coming through the store. So use your current experience based on how many times you go to a similar sort of shop, or buy a similar sort of product, and you can come up with, okay, maybe 10,000 people visit that store each year, I'm assuming, or you could do it, okay, I think there's about 100 people walk through the door each day. So it doesn't matter too much how you phrase it, but it's coming up with some sort of assumption that you can build up from. And this will give you your total number of customers. Somehow, I'm not too sure how this example is working, and then you can say, well, these customers are coming in and they may be buying about $50 worth of product. So that could be, okay, it's a clothing store, they may be buying, a t-shirt and a pair of shorts, it's about $50, or, something like that. So you can come up with an assumption based on the information in the case and also your own experience as well. And of course, once you've built this up, you've got a revenue figure just the same as with the other method. So that's all based on the number of stores, customers per store, and the revenue per customer. So as I said, there's a bit of estimation going on there and a few assumptions based on your own knowledge and building it up from what's in the case. You need to actually make sure that your numbers are matching what the rest of your team is talking about as well. So do feel free to actually go, hey team, I need some help estimating this, or hey implement person, how many stores are we aiming for again, and in which years are we going to get those stores? And you need to make sure it's clear around the whole team and they kind of have an understanding of what you're doing and you have an understanding of what they're doing as well. So of course, when you start valuing companies, make sure you're not giving a negative valuation or giving cash flows in the 3 years time that are negative, as in you've actually made more costs that you're getting in income. That should definitely not be the case. And of course, think about doing things in incremental changes. I do not believe you if you say you're going from 0% market share to 50% market share in 6 months, because it's probably very unrealistic unless the market's very small. So think about what's a realistic increment to increase things by, and don't go too overboard, because the judges will be asking you how you got your numbers. And of course, when you do the final valuation, if you're using MPV, make sure it's not a negative number, otherwise you've just told them that you're decreasing the value of their company, which they will not be happy about. So I just have a quick flick through some of the sort of example slides I think we've got here. But for the finance person, they've probably got some key slides that they need to output. The first is size of the prize, and you won't actually present this yourself. This is likely going to be presented by your intro person, so whoever's taking introduction will likely have this at the start of the presentation, saying our strategy and what we're going to present today is going to increase your business to $1 billion in revenue and an MPV of 50 million or whatever it is. So that size of the prize is likely going to get pinched by introduction. Well, at the same time, you'll likely cover in your part the valuation of each strategy arm and kind of some of the reasons about how you got there, along with some of the other key metrics that may be affecting that strategy arm and relating to that. And of course, that would all come together with a bit of a rack-up of how they all come together and build on the current valuation to get your future valuation as well. So there's a bit of flexibility about how you present and which order you do it. Some people like to say, first I like to look at the current valuation and then one strategy each, and then complete valuation and then key metrics. Other people like to sort of chop and change, but basically if you've got these components, you can kind of be a bit flexible in how you present it. And at the end of the day, you need to think about what's most impactful for the judges to hear. So here's the size of the prize example for what you'll sort of give introduction, and maybe you'll do it at the end of your presentation as well. So it's basically showing the current evaluation and where you're kind of heading and what impact you're going to have on the business, so that the judges really sit up and take notice. So the valuation of each strategy arm, so it could have a slide like this, which covers some of your sort of key assumptions or key things that you're trying to achieve. So we're going to open 1 store per year, we're going to increase prices to $3 from whatever it is at the moment, and at the end of the day, our marketing strategy is going to get you 50 extra people, so your MPV is going to increase by 42,000 or something like that. And then you could show this in something called a value bridge. So if you talked about each strategy individually, you could be like, well, here's our current, through strategy 1, we're adding whatever the number is, sort of $20,000 worth of value, and strategy 2 is adding another $100,000 worth of value, and this is what you get, sort of thing. So just have a quick look at. So before we do that, so for each strategy, think about using as many graphs as possible. Think about what's going to be most important to the judges. So quite often I have a graph with sort of revenue figures and how you're building that and what change that you're making. Or you could have, as I say, an MPV sort of for each arm of the strategy. Or it could be something like store numbers and customer numbers as well. So you can sort of do lots of different graphs and lots of different sort of graphs are probably the best way. You can sometimes do tables if you want to highlight sort of the different steps that you went through. But at the end of the day, the judges don't want to see every assumption. They just want to see kind of the output. And you can have a little box on the slide that has some key assumptions, and you don't need to talk through every single one. But if it's there and they ask, you can flip back and you'll be like, okay, this is what I used. Okay, so don't feel like you have to explain everything, because the finance role could be 10 minutes by itself if you talked about how you built your model. Okay, so really think about what's most important. So lastly, I'd like to cover key metrics. So this is something that's a bit different. It can be something non-financial, or it could be something in between a non-financial and a financial metric. So it could be sort of market share, it could be revenue per store, revenue per square meter at your stores. So you really need to show where that metric is currently and where you're trying to move that to and what you're going to achieve in the future. And of course you can do this for each sort of strategy arm may have its own key metric, or your overall sort of combination of strategies could be changing this key metric as well. So here's a few examples. It's things like costs, profits and sales are a bit more monetary in the way of key metrics, so I probably wouldn't really cast them as a sort of metric, because that's kind of covered when you do MPV and sort of revenue figures for your arms. But try to think about non-monetary metrics in which the judges can quite easily relate to. And for a retail case, there's things like number of stores, number of customers, dollars per square meter. And for not-for-profits, if you get one of those, it can be number of people helped, sort of percentage change in people going through the education program and stuff like that. It could also be market share or awareness as well. So just think out of the box and think what's most applicable to the company that you're talking about. So here's an example. Our initial market share was 10%, and through our strategy, blah, 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 we're going to grow this to 35% of the market. So that could be one of your key metrics. And as I said, for not-for-profits, it's a bit different. If you get a not-for-profit case, they don't want to know how much the charity will be valued at, probably because it's not really the point of their charity in the first place. You really need to think about what ill they're trying to solve, or what they're trying to solve in the society. So think about that at that level, and think about how you can sort of measure this. So it could be something like, we're trying to educate people on dyslexia in New Zealand. So our key metric is 1, how many people in New Zealand know that you exist. 2, it's the number of members that are part of your charity. And 3, it's the number of young children that are going through your educational programs and getting help out of your dyslexia programs. And of course, money is still important for a charity. They have to know how they're going to get the funding, because they don't make revenue off the people that they're helping. They have to get it through donations and other sources. So, and they do need that to survive and achieve their goals. So really think about that as well. But you don't have to present that sort of upfront as your revenues or your donations are increasing by 10% every year. You can kind of do that as secondary to the ill you're trying to solve. So I think that's me. I'm going to hand over, and I'm happy to answer any questions on that stuff at the end as well. Cool.
Thanks, Matt. So my name's Nathan. I'll just take you through the more sort of technical stuff of valuation. So when we're looking to see whether the strategies your team sort of implements is going to have a positive effect on the valuation of the company, and you'll do that through one of 2 methods. So that's going to be through multiples or through discounted cash flows. So the first one, we're looking at multiples method. So if anyone's done sort of higher level finance papers or even 251, you'll know what this is. So basically, NCC takes a pretty simple approach to it. We'll use an EBITDA multiple, which is earnings before interest, tax, depreciation and amortization. And we'll apply sort of a fixed multiple to that to arrive at a company value. So For small companies, you'll be looking at a multiple of 5 to 6, and it will increase as you get into larger companies going down. So that multiple sort of represents the risk of the company, and if we're valuing it, then I guess a larger company will have a lower risk and therefore a higher multiple. The second method that we'll use is the discounted cash flow method. So this is basically saying that the value of our business or the value of our strategy is equal to the present value of those future cash flows running into the future. So we use Matt's lemonade stand as a bit of an example of how this model works. So first off, you run it down in sort of an income statement format. So you use revenues starting off and you'll project that into the future. So for a given strategy, you might have 100 stands or 100 lemonade bottles sold in the first year, and that'll slowly increase over time as your strategy sort of comes into effect. At the same time, if you want to increase store numbers, then you're going to have to increase the costs you have there, so that's going to change over time. And that's going to have an effect on your earnings before interest, tax, depreciation and amortization through expenses. You're going to tax it at a given rate and look to have capex as well in that investment in stores. That's going to leave you with your free cash flow figures, and this is something you can use from your strategy. It's a nice output to have in terms of the actual cash flows you're going to be getting from the strategy looking into the future. And what we do is we look to discount those cash flows at a cost of capital to arrive at the present value, so what the value of your strategy is today to the company. So what we do is we use the weighted average cost of capital, and that's basically the return that investors require on the money invested in order to, I guess, satisfy them. So what you do is you discount those free cash flows over the life of the project or the life of the firm at that weighted average cost of capital using the formula seen. So that will arrive at the discounted cash flows, so that's the present value of those cash flows for the next 5 years, and then you'll use a terminal value. So you split it into two sort of segments, the first being in the 5-year segments, and then the terminal value is the value thereafter, so all the cash flows after that 5-year period. So that is estimated using so you estimate the value of the cash flows thereafter by multiplying your 5th year cash flow by 1 plus the growth rate, and then dividing it by your weighted average cost of capital minus the growth rate. And that'll arrive at a terminal value of 83 there, and you'll add those to your discounted cash flows found for the next 5 years. That'll give you your present value of the cash flows or of your strategy in the next sort of over the foreseeable future. So general tips for the finance role, I think it's quite important that you don't start putting up a whole lot of just numbers. So you want to round your numbers where possible, make it easy. It's important to understand that the judge is trying to absorb a whole lot of information in a very quick amount of time. So you want to simplify things as you can. So you want to round your numbers down and provide a snapshot of basically what your strategy is going to be doing. So that might include not necessarily introducing the valuation, but just introducing how your strategy is going to increase the valuation in sort of simple numbers. So if you wanted to have the calculations there for further reference for you in question and answer, you'd provide that on backup slides and not necessarily have it in your actual presentation. Further to that, you just want big, clear slides, and if you don't have enough data there, don't worry. The most important thing, I guess, the judges are looking for is the fact that your assumptions are grounded in good logic and that you've arrived at them in a way which is, I guess, sensible for their idea of how your strategy is going to be successful into the future. So that's us with